My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Suddenly we have brown shoots everywhere, and that's a good thing. Remember, we're on the lookout for a slowdown that would justify the Fed's position that we don't need any more rate hikes. When we get brown shoots, the opposite of green shoots, Wall Street laps it up because it means the Fed might win the fight against inflation. And that's why the Dow gained 264 points today, while the S&P jumped 1.2%, and the Nasdaq pulled at 1.59%.
That was easy.
It's been hard to parse this economy. When we got the February employment numbers on March 8th, they were so steaming hot that it felt like the Fed was blindsided because they've been talking about multiple rate cuts this year. And you don't do that when the job market's booming. Anything that makes the Fed look stupid hurts its ability to maintain price stability. Well, was the Fed really wrong? Just when Wall Street gave up on the possibility of rate cuts anytime soon and the Fed then joined them, we start getting actual signs of a weaker economy. It makes sense. Interest rates have soared. They're doing their job since that smoking hot February labor report, which was followed by another hot set of numbers for March. The benchmark U.S. 10-year has gone up by more than 50 basis points since the February report, making it more expensive to borrow money, which tends to slow down most of the economy, except parts of tech that have what we call secular growth, not bound by little Fed rate hikes or cuts for that matter. Yep, when they have the weakness, what do when you have weakness in the economy? You buy the Magnificent Seven and Friends, and that's exactly what we saw today. So how do you know if there really is a slowdown? It is not easy, but we've had some very big tells of late. J.B. Hunt, the nation, the fourth largest trucking company, had a solid fourth largest commerce company, let's call it that, transport company, had a solid January and even stronger February, but the business shrunk in March, and the company's total operating revenue dropped 9%. J.B. Hunt seemed almost mortified that it performed so badly. Prologis, world-leading owner of logistics real estate like warehouses, was a lot less apologetic, even though they lowered their guidance dramatically just a month after coming on the show, where we heard a much more bullish story. In that interview, we were told that there was only weakness in Southern California. A month later, there's weakness in Seattle, New Jersey, and Savannah. Why these markets? Well, Seattle's maybe where Amazon is. I don't know. Jersey's warehouse space for the whole New York area. Savannah, Georgia, that's supposed to be where the best region is. Put it all together, and vacancy rates for these warehouses are going higher, because even e-commerce isn't safe, and that is a big deal. Then we heard about a slowdown story from CarMax, the used car dealer. They blame the economy and cut prices of used vehicles, but they're still got hurt by financing charges. That's the bond market taking care of business. Remember, the bond market controls long rates, and bond yields are now up huge, which makes auto loans a lot more expensive because fewer people buy cars. Snap-on helps small business owners with fresh new tools, and it got walloped with some really weak numbers. That's a genuine surprise from what's usually a very reliable company selling to decently capitalized mom-and-pop companies. We had weak numbers from RH, Steel Restoration Hardware, too. The retailer talked about a big game, a really big game, about how things are going to get better. I think one day they will, but higher rates and a lack of new homes for sale have hurt the business, and the stock's been clogged. Hey, you know what? Today was Sherwin-Williams' turn. The paint maker said there was demand choppiness, something that looked that took a lot of people by surprise, because anything home-related had been quite strong. So the stock, it got clobbered. And then there's Nucor, the fabulous steel maker, which saw some of its grades go down in price. First time I've seen that in a while, miss their quarter. Sure, volumes were up quarter over quarter, but the price declines were stark, signaling the maybe broad weakness in construction and heavy machinery. We're going to talk to the CEO later, but a miss here is a miss, even as there were many good things about it. Cleveland-Cliffs had a miss, too. There's a steel company called Auto-Related. On top of that, we've had the collapse of Express, the formerly trendy mall-based apparel chain with 600 stores. It's agreed to close 95. A group of investors led by Simon Properties buying the rest. If only so their malls don't have a lot of empty storefronts. We even got 2 restaurant chain bankruptcy filings. There's Tijuana Flats as a southern 90-store Tex-Mex chain, along with the 40-store Oberweis Dairy in the Midwest. Red Lobster, with its 650 locations, is also in financial trouble after a disastrous all-you-can-eat shrimp promotion for $20. They took a beating. Well, I mean, that's bad for them. They just hired a restructuring expert, probably contemplating bankruptcy. I don't know. Of course, you could say this is all anecdotal. The brown shoots are really all one-off situations. Real estate, small business, high-end furniture, paint, freight, steel, electric vehicles, restaurants. There's almost no pattern here, so it's easy to argue that the economy is still humming. But that's a pretty big mosaic. Except today we got something different. We got empirical brown shoots in the form of the S&P Global Flash U.S. Composite Purchasing Managers Index, an aggregate number, and it was so weak that I think it actually put a near-term Fed rate cut back in the table. Spurred huge buying today in a 2-year government auction. Those people were anticipating there could be a rate cut. I'm going to quote extensively from the report because it's just so on point. Listen to this, quote, U.S. business activity continued to increase in April, but the rate of expansion slowed amid signs of weaker demand. The latest rise in output was the smallest in the year to date, reflecting reduced rates of growth in falling orders in both manufacturing and services, end quote. Wow, that'd be a forest of brown shoots. But could we now be seeing stagflation where business slows down but prices keep climbing? No. Listen to this bit of positive news. Quote, rates of inflation generally eased at the start of the second quarter, with both input costs and output prices rising less quickly as the composite level, end quote. Hey, that's exactly what we wanted to see if we're going to get a Fed rate cut. This PMI report showed for the first time a reluctance in hiring. Get this, quote, a number of survey respondents indicated that they had held off on backfilling positions following the departure of staff. As a result, employment decreased for the first time since June 2020, end quote. Look, we never want to be rooting for job losses, right? But if you want to beat inflation, you need to have the pace of hiring to slow. We saw job cuts tonight at Tesla, and the company had a declining number for earnings per share, but it was still better than expected. That's in keeping with the brown shoots that I am talking about. Although there was no brown shoot from NVIDIA because there's a slide in the Tesla deck which shows a massive increase in the number of NVIDIA chips used, presumably for their cars. I have been worried about services being too hot, okay? That's something that's obviously a problem because most of the weakness I've seen came down to manufacturing. But the PMI report says, quote, the overall reduction in workforce numbers was centered on services, where employment decreased solidly to the largest extent since mid-2020, end quote. Now, get someone, this is it. Get this. The report goes on to say, quote, excluding the opening wave of the COVID-19 pandemic, the decline in services staffing levels in April was the most pronounced since the end of 2009. Holy cow, that's the Great Recession.
The house of pain.
But for the bond market.
House of pleasure.
You know, they really hammer this point home. Listen, the more challenging business environment prompted companies to cut payroll numbers at a rate not seen since the global financial crisis. Wow. Real bad news for the economy. But remember, we need bad news for the economy because that's what cools off inflation, something that's also noted in this PMI report. That's what brings us rate cuts. So let's think this through. We have a host of companies that we know are doing well, GE Aerospace, American Express, General Motors, SAP, which is Texas Instruments tonight, which is, by the way, SAP is on later in the show. You'll love it. But earnings have become spotty. Oh, Spotify was good, too. But we know there's no let-up in travel or housing. Pulte put up some very strong numbers today. Pulte being a big home builder. But the bottom line, when you combine the anecdotal evidence with the empirical PMI report, you can see that right now at this moment, the brown shoots are infecting the green. And that's exactly what we need for the Fed to justify cutting rates. So, of course, it happens right as everybody's given up on the possibility of a rate cut. Ryan in Washington. Ryan.
Booyah, Jim. This is Ryan from Gig Harbor, Washington.
Man, good to have you on the show. What's going on? What's happening?
Jim, do you still think there's more upside for Amazon?
Yeah, absolutely. Why not? I mean, Amazon is the great equalizer. I think it's got the Amazon Web Services going to be incredibly strong. And by the way, just so you know, Amazon advertising is on fire. I want to go to my namesake Jim in Georgia. Jim.
Hey, good afternoon, Jim. Booyah.
Booyah back.
Hope you're doing well. Hey,
Couldn't be
Jim,
better.
Just one. Great. Glad to hear that. What are your thoughts about this acquisition between Kroger and Albertsons?
I think the government's going to block it because they're still reeling from the day that they let that Safeway deal go through, the one where they gave all the stores to Hagen, and then it became a Hagway. They actually call it that. So they're not going to do that deal. I think they'll block that one. Anyway, right now the brown shoots are indeed infecting the green shoots. Remember, we're in favor of brown shoots because we want rate cuts. It's exactly what we need for the Fed to justify cutting rates just when everyone had given up. Well, isn't that exactly the way it works? Mad Money tonight. S&P shut the lights out of the quarter with the stock soaring in response, and I'm learning more about what's working for the software giant with the company's top brass, and nobody is interested about it except for me, but you ought to be interested because it's really good. Then on the other side of the coin, Newport is melting down after reporting last night. So are investors getting a buying opportunity in the steel maker? Or is this a warning for what's to come? I got the exclusive. And Mattel's trying to find its footing in this post-Barbie movie world. And I'm hearing how the company fared last quarter. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.